I'll record this so that we can put it up on Canvas and you can look at it later. Some of you are still looking at those, I think, so I'll just go ahead and do that. And we're going to start out with Chapter 6. And what we're going to be talking about in this context for Chapter 6 is the cash account. We spent some time in Chapter 7 with accounts receivable, so if you haven't noticed, we're kind of going through the balance sheet through our current assets. So we did a little bit with inventory. We went ahead and took a look at the accounts receivable. Now we're coming back and looking at cash, right? And after our midterm, well, Chapter 9 we'll do a little bit with liabilities, although we understand quite a bit of that already. And then after our midterm, we'll start dealing with longer term. Well, we did our long-term assets in Chapter 8, and we'll start dealing with our long-term liabilities and our common stockholders' equity after the midterm. So we're really just going through the balance sheet. We started with the income statement, right? Dealing with revenue recognition, etc. Okay, so if you take a look at this slide dealing with internal control, we mention it in this chapter because if you have cash, cash is something that is going to be subject to theft, etc. And so this is something that we are absolutely going to want to make sure that we have the appropriate internal controls over. Okay. Now, if you're a publicly traded company, you are mandated under something called the Sarbanes-Oxley Act to have the appropriate internal controls. Okay, and a company literally needs to provide in their annual report an attestation that they have the appropriate controls. Okay, so this is something that is for public companies, and they literally get an opinion from their auditor saying that they have the appropriate internal controls. And the standards for doing an audit over the internal control are put out by the Public Company Accounting Oversight Board. Okay. Now, we start to talk about internal control, and one of the key aspects of internal control is the safeguard of assets. The other is the reliability of financial reporting. Both of those are objectives, our internal control. And in this class, we're thinking about safeguarding of assets because we're talking about cash, and cash is the primary asset that ends up getting stolen at some point, right? And so we're going to be looking at the controls there. Now, when you look at the internal control, the process here is to have a good control environment, to do risk assessment that will see how that will affect our objectives, our reliability and financial reporting and safeguarding of assets. Then we put control activities into place to help us achieve those objectives. Then we go ahead and communicate to our employees what their responsibilities are under the internal control, what they have to carry out, and then we monitor to see that the internal controls are achieving the objective of safeguarding assets and ensuring reliability in financial reporting. Once we monitor, we take that back up to the board of directors, the audit committee, the top of the company. They make decisions, they assess risks. So this could have been put into a circle, right? And we have what? Safeguarding of assets and reliability of financial reporting as our objectives, and this is the way that we achieve them. Okay, good. So what are some of the control activities, which is what we're going to be focusing on here in a couple of the next slides. One is establishment of responsibility. If I tell you that you're responsible for that cash drawer, and that nobody else is going to be responsible for that cash drawer until there is a handoff of responsibility. And usually, if you ever go to the store, you see the cashier. My luck, I always get in the line right when they're changing over, right? And what happens? The person takes their cash drawer. The new person shows up with their cash drawer, right? And they need to reconcile that. So that's assignment of responsibility. If you assign somebody responsibility for a specific asset, right? Okay, just like when you start in a new job or something, they give you a computer, they give you a set of keys, you got to sign off whatever, right, that you have that responsibility. So that's assignment, establishment of responsibility. Okay, now we also have segregation of duties. Okay, segregation of duties says that you should not allow someone to overlap in their responsibilities. Okay, the three responsibilities that we really try to separate, okay, when we talk about separation of duty, is going to be authorization for the transaction, record keeping, and custody of the asset. Okay, so we're going to what? I call this the Ark of the Covenant. Okay, we're going to separate what? Authorization, record keeping, and custody. We want to separate those three things. So what happens? If somebody is responsible for collecting cash, do we also let them record the receipt of cash in the accounting records? No, right? Because what's going to happen? They're going to say, okay, one for you, one for me, right? And they'll keep to write down one, they'll keep the other one, right? And so what do? We separate that, right? We separate the what? The record keeping from the custody of inventory, don't we? Why? We don't want somebody saying, okay, well, gee, one of these stereos looks really cool. Let me take this one home and I'll just leave the other one here, right? And I'll write down that the one never showed up or something. So we try to separate those, right? Okay? Okay, good. Then what? We also have documentation procedures. Separate authorization, record keeping, and custody. That's separation of duties. Then we also have documentation procedures, and we use pre-numbering. Pre-numbering is a key internal control because what happens? Well, we have our sales invoices. 1, 2, 3, 3. Huh? How'd you get another 3? What's going on, right? Or if there's not one with a number, how come? Maybe that second one is a fictitious sale, right? 1, 2, 4. Huh? Where's 3, right? We identify that missing document through the pre-numbering. So pre-numbering is a key control activity. Okay? And then you have, all kinds of physical controls, safes, locks, a password accessing, the accounting records would be an example of a physical control. So all of these are physical controls, all these locks, etc., right? Can you think of a physical control that they're not showing us here? Huh? A person? You mean like a guy with a magnum standing in front of a jewelry shop? I say that because my mom's cousin owned a jewelry shop, and there always used to be some guy with a magnum whenever we'd go in there, sitting there in the front of the jewelry shop. That was their security. I think that was really kind of a dumb security, right? What is he going to do? Shoot somebody in there for stealing? I mean, come on. So anyway, yeah, I guess that could be a physical security. I'm thinking of a lockbox facility we talked about, right? Did we talk about a lockbox facility in here? Lockbox facility is when you have collections from your customers, but rather than it going to your employees, it goes straight to the banks that offer a lockbox function. And what the banks do is they go ahead and they scan those checks, and they go in and they update the account that way. I actually had to go visit a lockbox facility that was being used by the federal government. When you pay your taxes, it's sent to a P.O. box in San Francisco. It gets on a truck in San Francisco, goes south on 101, and goes across the San Mateo Bridge to the greatest city in the world. What's on the other side of the San Mateo Bridge? Hayward. It goes to a facility in Hayward. And so when Hayward came up in the sample in Washington, they pulled the sample. I wasn't even on that job. And some guy knew me. He goes, oh, we got to send John over there. He speaks Hayward. He'll know how to talk to him. So I ended up going to Hayward and seeing the way the federal government uses a lockbox facility. The reason we were doing that is some of the lockbox facilities, not the one in Hayward, some of the lockbox facilities were shredding the tax returns because they couldn't keep up with the quota. Is Congress happy when checks that are on their way to the Treasury's bank account get shredded? They weren't too happy, right? And so they asked us to go take a look at that. So that's another key control over cash that they're not talking about here, which is a lockbox function. It's a service offered by banks, right?
A lot of your, like if you get a check, you get to pay a ticket off. Almost all the cities all send them the lockboxes somewhere. So you get a ticket here, you'll see you ask, you're like, why is it going to Los Angeles? That's why.
Yeah, it's going to a lockbox facility down there, yeah.
Fremont, so if you're down off of between Paseo and Fremont Boulevard, off of Walnut, there's that big giant building, Wells Fargo, that's their lockbox there.
Oh, is that right?
No windows and anything, it's like 3 stories, it's huge.
Yeah. Yeah, they usually don't put on here lockbox, cash being sent here, checks being sent here. It's a very innocuous looking building. And for the federal government, if you walk in there, in January, we thought one of our first findings was going to be, well, they don't need all this space. And then what? By March, they need every inch of that space, right, as tax returns are starting to be filed, et cetera. So, okay, anyway. So, okay, human resource controls, bonding somebody, right? Making sure that they have a background check, et cetera, when you bring them in. All of these are internal controls. Okay, limitations of internal control, human elements, cost should not exceed the benefit. So the size of the business, right? It's not a one size fits all. Okay, so you might actually combine some duties that you might separate in a larger company. Okay, but then you'd have to have some other checks and balances involved. Okay, I audited a child care center one time where um, the nurse, because they had to have a nurse on the facilities at all time, the nurse was also the bookkeeper. Okay, and that was interesting because I'd say, well, can I please see your general ledger? My general what? Okay, so that was an interesting assignment. What I ended up doing was creating the general ledger for them because they didn't have it. I just took their cash receipts and disbursements journal. Well, there's a method to my madness. They're in Washington, D.C., so all I had to do was get on the train, and I got there on Friday, and I had a laptop, and I sat there and put all the transactions into a general ledger software, and by Friday afternoon I was in Boston. It was great. So I spent all then came back, and I had something to audit at the end of the engagement. Okay, so different sizes for different companies. Okay, voucher system is going to be what? A voucher system works like this. I have voucher 379, and then I have expense 1, expense 2, expense 3, right? And I would be responsible for reviewing all of those expenses, signing off on that before those transactions are allowed to go through and those checks are allowed to be paid, right? Okay, so that's a system called a voucher system where everything goes through a central point of someone who has responsibility for those before we allow those checks to go through. That's called a voucher system. Okay? Okay, good. So most of our focus here is going to be on something called petty cash. Okay? And with petty cash, what we do is we essentially are going to have cash on the premises for small purchases. So we have $100 in the petty cash, for example, right? And something comes up that we have to buy stamps, let's say. What we're going to do is we're going to set up this petty cash, say $100, and when we need stamps, we'll do what? Go into the petty cash fund and pay for those stamps, right? Now, when we do that, we, of course, will need to include the receipt for the stamps in that box. And at the end of each period, typically monthly, we'll go through and we'll compare the receipts that are in there for the amount of stuff that's been purchased versus the amount of cash that is still sitting in the petty cash fund. And that should balance at the end of the month. Now, it often does not. We usually are a little short, but we could be a little over the cash, and we'll debit or credit the over and short accordingly. Okay, so let's just go ahead and take a look. And this company decides to establish $100 of petty cash. Okay, now let's say that before we did this, the company had cash of $1,000 on their balance sheet, and we go ahead and we do what? We debit petty cash and we credit cash, right? So after we make that journal entry, what will our balance sheet look like? How much cash will we have? We'll have 900 of cash because we just credited cash, didn't we, for 100? And we will have what? We'll have petty cash of 100. Do we still have $1,000 cash? But we have simply come out and said, hey, 100 of that we're going to put in a petty cash lockbox, not a lockbox like what I was describing, a real box, right? Okay, with a lock on it, or maybe sit in someone's drawer somewhere or something, right? So how much petty cash do we have? $100, okay? Then what? Then at the end of the month we go and we look, and as the month goes by, people take money out for postage expense to pay freight out because we have to pay the guy who delivers our goods and stuff. and to what? For various miscellaneous expenses. And we look in there and we count up the receipts. And when we count up the receipts, how much are in there? 44 plus 38 plus 5, that's what? 87, isn't it? Okay, so we've used $87 of cash, haven't we? But notice what we do. We don't credit petty cash, we credit what? We credit cash for that $87, don't we, and debit the expenses? Right? We're debiting the expenses for the different expenses that are in there. We credit cash. Now, when we credit cash for 87, right, how much cash is left now? 813. Okay, which is correct. We have, we're going to sit there and we're going to do what? We're going to take some cash now, $87, and we're going to put it back into the petty cash fund. Does the petty cash fund have $100 in it again?
Yes.
Does it still have 100? Yes, it does. I credited cash for $87, right? There was what? There was $13 cash sitting in there. I credited cash for $87. So my cash account shows now what? 813, and I indeed do have $913, don't I? I have $100 sitting in the box, in the petty cash box. Now I had 13. I just put what?
87.
I just put 87 in there, so I have how much now? $100 sitting in the petty cash, and I have $813 sitting in my bank account, right?
So you credit cash, you debit petty cash, and back the same amount, so that always stays 100.
At the very beginning, I debited petty cash, I credited cash for 100, and it stayed at it stays, and then it just stays at 100 after that. And when I replenish, I take money out of my bank account and put it back into the box, and the amount showing in the box stays at 100, doesn't it? Okay? I mean, just ask a basic question. How much cash do I have? I had what? You all agreed with me that I had 1,000 when there was 900 and 100 in here, wasn't there? I spent $87 of cash, didn't I? So if I take what? I take 1,000 minus 87. How much cash do I have? I have 913 cash. How much cash am I reporting here? 913. I'm showing 813 in my cash account and 100 in my petty cash account. And I'm doing that because I've taken money out of the bank and put it in the box, right? So each time I use up cash, I don't sit there and I don't credit the petty cash. I establish the petty cash fund. I leave it at 100. And as I use cash, I do what? I use it out of my regular cash account, right? And stick it into that box. Now there's $100 sitting there again. Now this one worked out fine, didn't it? Because what? Because the amount of the receipts matched the amount that, well, the amount of the receipts that were in the box plus the amount of cash that was left in totaled the $100, didn't it? So it worked out okay? Okay. Now, what happens? Frequently, there's going to be a different amount, okay, that is sitting in the box. So now we look, the receipts still total what? Still total 87, don't they? 44 plus 38 plus 5 is still 87, isn't it? So there should be $13 sitting in the box, shouldn't there? But when I look, there's only what? There's only $12 sitting in the box. So there's $1 missing, isn't there? Guess somebody went and got some coffee and forgot to put the money back in, right? Now we're not going to arrest somebody over this, okay? And, you know, if we had 10,000 in the box and we couldn't find it, that might be a little bit more of a problem. But we're not going to sweat $1. So here's the way you look at these. You sit there and you say, okay, there's supposed to be $100 in the box, right? To start with. I spend what? I spend 87, so there should be what? Should be 13 left, shouldn't there? How much is actually left? $12, and so you know that you are $1 short, aren't you? Okay, this is the way you analyze these. Okay, and then you go ahead and you say, well, look, if I have $87, if I'm supposed to have $100 in the box, and I only have what? $12 left. That means to get it back up to 100, I need what? I have 100. I'm supposed to have 100. I have $12 left. I need to do what? I need $88 to get it back, don't I? Okay. So you're going to sit there and you're going to credit cash, you know it, for $88, aren't you? You know you got to credit cash $88 to get it back to $88. And then you're going to debit these expenses. Okay, you're going to debit expense for what? Can I just do the total here, guys? 87, so I'd have to write all three of these numbers. I'm going to go ahead and I'm going to do what? Debit the expenses for 87, right? And what do I need, a debit or a credit to make this journal entry balance? I need a debit of $1 to make this journal entry balance, don't I? That debit goes into the cash, and they call it cash over short. Okay, cash over / short, because it could be over. But if it's a debit like this, it's the what? Cash is short, isn't it? Does this journal entry balance? Yes. Does journal entry balance now? Okay. Okay, so you take a look. That's the rest of this journal entry. They go ahead and they debit the cash over short, and then they credit the cash for the full $88, right, which is what we wrote up here on the board. Okay, so again, the process that I would go through, guys, every single time is I would sit here and I'd say, well, look, I know I'm supposed to have $100 in the box. I would do that first. Supposed to have $100 in the box. If there's only $12 left, I need what? I need $88 to fill up the box again, don't I? So I go ahead and I know I have to credit cash for what? $88. I go ahead and I do what? I put in the expenses, because that's going to be given, and then whatever I need. If I need a debit to make the journal entry balance, that's the short. If I need a credit to make the journal entry balance, that's the over, right? Okay, because that means I have a little bit more left in there. And then, just to verify the over short, I like to do this little analysis too, which is what? $100 minus 87. I should have 13. I only have 12. Yep, I'm $1 short, right? And if you take that approach to every single one of these questions that you're going to be seeing on the practice exam and on your midterm next week, it makes this pretty easy. Okay? Okay? Question? Okay, good. Let's go ahead then and let's do this bank reconciliation. And do you guys reconcile your bank accounts? Nobody does anymore because of online banking. I mean, you sit there and you do what? You look, and as soon as you're, you can't even, by the time you're walking out of Pete's, it's like, okay, they got me, right? So, these days it's so instantaneous that people don't do this personally. But in business, absolutely, right? Okay, if I was coming and I was auditing you and you didn't reconcile your bank accounts, I'd have a slam dunk finding. The agency, the company does not reconcile their bank accounts. They should do that on a monthly basis, right? Okay. If we're a bank, we reconcile our accounts daily. No one goes home unless everything reconciles. Okay. So we're going to go ahead and study this a little bit from the standpoint of a company. And when you read these questions, okay, you need to determine first whether they're giving you the bank balance or if they're giving you the book balance. Bank balance is the balance that shows up on the company's bank statement. Book balance is the balance that is showing up on the company's books. And then you go ahead and you perform the reconciliation from there. Okay? So we look at this particular question. They say the bank statement for Laird Company shows a balance per bank of $15,907. On this date, the balance for the books was $11,589. Using the reconciliation, I'm not going through steps, determine the following, prepare the reconciliation using these following items. Okay, now, in this question, for this example, they gave us both the book and the bank, didn't they? most of the questions will choose one or the other, okay? And so I'm going to go through and I'm going to show you how we do the reconciliation using both in this example, and then we're going to look at some of the practice midterm questions. You'll see usually they give you one or the other. They don't give you both, okay? Okay, so let's go ahead, and I would stop texting and start looking at this because it's real easy to get lost in this, okay? So this is not texting time. Okay, so, huh? Okay, well, I didn't call the person out. I never do. Okay, so it would have been better just to ignore the comment. Okay, okay. All right. Okay, so let's just go ahead and let's take a look at the balance per bank. Okay, and balance per bank, I'll start with that, is 15,000 what? I'll just write it down. Balance per bank is 15,907.45. Okay. Okay, good. So we're going to start with that, and we're going to reconcile to what? The correct cash balance. So we're taking what the bank has told us, and then we're going to adjust this for things that the bank knows about that the company does not. Okay, the bank is saying, excuse me, the company, we're going to, so let me strike that. We're going to start, forget what I said there. We're going to start with the balance per bank, and then we're going to reconcile this for what? For things that the company knows about that the bank does not yet know about. Okay? Huh? Hasn't cleared the bank, they don't know about it yet, right? Okay? So what's going to happen? We take a look, and we're doing this as of April 30th. They send us this. And they tell us that there was a deposit in transit April 30th. They deposited it, but the bank didn't know about it until May 1st. So it must have been after 6 o'clock or something that the deposit got there. The bank doesn't find out about it until the next day. So does the bank know about the deposit in transit on 4/30? They do not, and that's a deposit. So we're going to go ahead and do what? Add that deposit in transit, and we're going to add what? 2,201? Does the bank know about that? So we have to add that to the what? Cash balance to get the correct April 30th cash balance, right? Okay. Okay, good. Then we have these outstanding checks, and these outstanding checks are checks that we had written by April 30th, but they hadn't cleared the bank until sometime after. They have to go to whoever we're paying them to. They put them in their wallet for a few days before they finally go to the bank and deposit them, right? Okay. And so what happens? Since those are checks that were written against our account that the bank didn't know about until after April 30th, what do we do with those? We subtract, good, the what? Outstanding OS checks, right? And so that's going to be what? 5904? Guys, the phones need to be turned off and all that stuff. I know there's a lot going on tonight, but you need to stay focused, and I don't want to be hearing phones chiming all night. Okay, so we've got what? This 5904? Okay. Then what? Then they tell us there's an error. Laird wrote a check for 1226, and the bank correctly paid the amount. However, Laird recorded the check for 1262. So we deducted too much from our bank account for that check, didn't we? We deducted 1262 and we should have only deducted 1226. Somebody transposed the numbers. Okay, and so what? That's a $36 difference. We wrote the check for too much, so we should do what? For this particular one, we should add this error back, right? We should add that error? Okay, because we wrote a check for how much? We recorded in our cash register how much? 1262, but the check was only what? 1226. We wrote the check for the wrong amount. We just wrote it incorrectly in our system, right? Okay. And so we're going to go ahead and add that money back. That's $36. Because what the, oops, wait a minute. Who made the error?
The company recorded the check at 1262.
We made the error, right?
We made the error.
So the bank knows, we don't need to adjust the bank balance. They deducted it for the right amount, didn't they?
Yeah, it's our records that need to be.
We're starting with balance per bank.
Oh, yeah.
And we're putting things down that what? That the bank doesn't know about, right? The bank recorded the check for the right amount. We don't have to fix the error for them. We have to fix the error in our books, don't we? We're adjusting the bank balance right now, aren't we? The bank didn't make the error in their books. They recorded the check for the right amount, right? So we ignore that. The bank has the right amount. The bank correctly subtracted. This is the bank is saying, hey, I've got $15,907.45 in your account after I've subtracted that 1226 check for the right amount, right? I've subtracted it for the correct amount. And so they're okay. They're good, aren't they? Okay, so we don't have to adjust anything for them. We tell them, oh, yeah, well, we've got some deposits in transit you need to know about, so we add that. We wrote some checks that you don't know about, so we have to subtract that, right? But they got the right amount of the check. We're the ones that have to fix our books for that, not the bank's records. The bank's got the right bank balance, okay? Then what? Then we keep reading here, and we have these bank memorandum, and we have an NSF check from J. Barron for $425,000. What's an NSF check? Non-sufficient funds check. We deposited a check, and the bank is telling us what? It bounced, right? So the bank has already done what? They've already not included this in this balance because they know the check bounced, right? Okay, so we're putting what? We're making adjustments for things that the company knows about that the bank does not. The bank is the one telling us about the NSF check, so we can ignore that, right? Okay, then what? Huh? It's already included. Debit charge for printing the company's checks. They already know about it. They've already subtracted that from the bank balance, haven't they? So I don't have to do anything with that. Credit collection of a note receivable for $1,000. Hey, they must be doing a lockbox function for us here or something, right? Okay, but they already know about it. I don't need to adjust their balance, right? I don't know. I'm not here to teach. That's like asking me, will the answer always be 5? I mean, I'm not going to get into just a one rule thing, but I'm thinking you're going to have to read the nature of these things to know. Don't rely on if it says bank memorandum, okay? But you should understand these things more specifically, each one.
But if it just says charge for printing company checks, does that mean that the bank already knows?
Well, who would charge you? Who prints checks for you? The bank prints them. You tell the bank, hey, print me some checks, right? I need some more checks. So the bank charges you for that, and they just deduct that from your bank account. So they already know about it. Okay? So I just don't want you to, hey, okay, bank memorandum, because then they'll put something not under bank memorandum on the test, right? And then you're going to have to know the nature of what's going on with that. Okay? So we have this collection of note receivable for $1,000 plus interest earned. The bank knows about the interest earned, don't they? Okay, so when I'm adjusting the bank balance, the two big ones, and this you can kind of memorize, is going to be what? Deposit in transit and what? Outstanding checks, right? And when I do all that, I get a corrected cash balance of how much? $15,907 minus the 20140. Plus. That's an add. 20140 minus the 5904 gives me what? What? 12,204.85, you say? 12,204.85? Okay, good. Now, let's go ahead and let's see if we can get that number to match what the company records are saying. Okay, so that's the corrected balance. Okay, good. Now let's come over and let's do it for we'll start with what? Balance per books, which is what? 589.40. 45. Okay, and now we're going to start to adjust this for things that what? That the company, that the bank knows about that the company does not, right? This is the company's balance, and we're going to adjust it for things that the bank knows about that the company does not. Okay? So does the company know about the deposit in transit? So we ignore that, right? Does the company know about the outstanding checks? Yes, they do. They wrote the check, so we ignore that, right? Okay? Okay, good. How about the error? The error they didn't know about till the bank told them about the error, right? That they hit that for $36 too much. So for that error, we're going to add that back, right? Okay, good. How about all these other things? These bank, what's your name, sir? Andrew, you wanted to just say, oh, the bank memorandums, right? We got to pick these things up, don't we? Okay, because the bank knows about that. So the NSF check, if a check bounced, what should I do with it?
You gotta record it.
What do you want me to do with it? It's either the answer is either add or subtract on these reconciliations. I'm going to subtract it because the bank didn't clear the bank at the end of April, right? The check bounced. Right? If someone gives you a check that bounced, does the bank say, "Oh, that's okay. Well, go back and get the money from him and just pay us back later"? They just snap that out of your bank account, don't they? Okay, so that's got to come out 425.60. How about debit charge for printing the checks? Print checks? That's a charge, isn't it? So what's that? $30? Not 30,000, but 30. What else? Credit collection, note receivable for what? For $1,000 plus the interest is 1,000 plus interest of 50, but they charge us a collection fee of 15, so we netted 1,035 for that. Right? Okay, so we're going to pick that up, aren't we? That's going to be an add of what? 1,035? Okay, good. And so when you go ahead and you start with what? $11,589.45. And then you do what? You add 36, you subtract 425.60, you subtract 30, you add 1,035. I hope you get what? 12,000, that number? 204.85? So this thing reconciles, right? Don't you? Oh, sorry. I missed my cue. Boom, boom. Right? Okay, so what happens? Don't you love accounting? You love it when it balances like that. You hate it if it doesn't, right? Okay, but what happens? We just go through, guys, with these reconciliations and in the questions that we're going to look at here in a couple of minutes, we're going to do what? The questions are either going to give you, they're not going to make you do both because it would be anticlimactic if they give you both. You'd sit there. They're going to give you one or the other. They're going to give you what? They're going to give you the the book balance. You're going to have to adjust the book balance for things that the bank knows about that the company doesn't. Or they're going to give you what? Bank balance, and we're going to have to adjust for things that the company doesn't know. We're going to adjust the bank balance for the things that the company knows about that the bank does not, right? Right? Okay. It's all right. I know you understand it. It's just hard to say it. Trust me. Okay. Okay. No, that's what I'm saying to you. It's hard to say it, right? Okay. Okay, good. So let's go ahead then. And, oh, wait. I'm not sure that we're ready for this yet. Now, how do I get out of this? No way out. If you go that far, you're stuck. Okay, so I'm going to go ahead and discard whatever. And, okay, that's all I think I was next on the slides. I'm not going to go to slideshow for that. There they go. They gave me the same thing that we did up here on the board, right? Okay. Okay, good. Any question on that? All right, let's go ahead then with all that. And let's take a look at the Chapter 6 quiz now, right? Chapter 6 quiz. Okay. Guys want an election update before we go into the quiz? Uh,
Thumbs up.
how much?
137 to 104.
Okay, so that's all the East Coast though, right?
That's everything that's dark colored right there. He's leading the pink ones. She's leading the light blue.
Yeah, so it's still early in the.
The red and dark ones are the only ones.
So
If
it's gonna be all dark from there on? It's gonna be all.
Don't know, like,
you got to wait for the different states to come in is the problem, and they took my map from me. There it is. For example,
Virginia, there's only 0.3% separated.
well, no, but you got a big problem that he's ahead in Minnesota because he needed to flip one of those states. If he's ahead in Minnesota, that's a problem.
Florida and Minnesota.
Yeah. Actually, and he's also ahead in Michigan. Yeah, so that's a problem. And Virginia. Well, yeah, and Virginia. And North Carolina. President Trump. Okay. All right. So let's go ahead and let's take a look now at this one, if anyone can focus after that, right? Okay. And so let's go ahead and let's take a look at this one, guys. We got to focus because we got our test next time. So try to focus. So we're sitting here and we're saying what should be the adjusted cash balance at April 30th. You know, don't worry about the year. April 30th here. So they're giving me the balance per bank statement, and then they're giving me information. They want the adjusted cash balance. So if I take the bank statement, which is this 39,300. Okay. And then we start adjusting for things that the company knows about that the bank does not know about, right? Okay, so how about this deposit and this NSF check?
Subtract.
I'm making adjustments for things that the company knows about that the bank does not, right? So who knows about the NSF check? The bank knows about that, so I ignore that, don't I? Okay, how about this deposit in transit? I'm going to sit there and have to add that because the bank doesn't know about that. How about the outstanding checks?
Subtract.
The bank doesn't know about those, right? Because they haven't cleared the bank yet, so I subtract that 5,200. So I add the 5,000, I subtract the 5,200. How about the bank service charge? The bank knows about that, so I ignore that, don't I? And when I do the math on this, do I get this 39,100? Right? Okay. Ignore this question, guys. I put that in at one time when I was making the D is the correct answer, but ignore this. I put that in there one time when I was making my classwork backwards through that same information to give me the balance per books. I'm not going to do that to you. I'm not going to make you work backwards through it. So just don't worry about that. Okay, that's not even doing a reconciliation. Okay, good. Let's take a look at this one. and they say here that, let me bring this back down to the right size. They say here that we have the petty cash fund of $100 is replenished when the fund contains $4 in cash receipts for $94. The entry to replenish the fund would, and they ask us for one of the debits and credits, and what I'm going to suggest you do is you just do the whole journal entry. I mean, don't sit there when you're focusing on these and trying to just, twist your mind into just that one journal entry. Do the whole journal entry, okay? And so what happens? If there is $4 cash and I'm supposed to have 100, how much more cash do I need in there? I need $96 more cash, don't I? Okay, so I know I'm going to credit cash for what? For 96, and then they tell me that there are receipts in there for how much? For 94. When they tell me there's receipts, that means there's, what you get from a cash register saying that you spent money, right? And so what happens? That means there's expenses in there of what? There's expenses of 94. Do I need a debit or a credit to make this journal entry balance? I need a $2 debit, and that is for my what? Over/short account. And if I'm debiting it, it is what? It is short. And then just to verify that it is short, I'm sitting there and I'm going to do what? I'm going to say, well, look, I'm supposed to have $100 in there, right? Minus what? Minus the 94. So there should be what? $6 in there, but there's only how many? There's only 4, so I'm $2 short, right? Okay, and I always just do that just to make sure I haven't, missed something. So that means that there's a debit to cash over short, and they just call it over short, and that they use one account because some periods it might be over, some periods it might be short, so they just have it toggle back and forth, right? Okay? Okay, good. Let's take a look at this one. $100 petty cash fund has cash of 13 and receipts of 84. The journal entry to replenish the account would include, I'm supposed to have how much in there? I'm supposed to have how much in there? I'm supposed to have how much cash in the petty cash fund? $100. I'm doing what? I am sitting there with 13, so I have what? I have to put 87 back in there, don't I? Right? Okay, so I'm going to credit cash for 87. I'm going to look at the expenses, and the expenses here are what? Expenses are 84. So I have cash over short of what? Of $3? Okay, and so what's happening? Well, I have to credit cash for 87. I mean, I got it right there, didn't I? But I tell you, do the whole journal entry, right? And then just to verify that cash over short, I'm supposed to have what? Supposed to have 100 minus the 84 means I should have had 16, and I actually only have how much? 13. Yep, I'm short, sure enough, $3, right? Okay, let's take a look at this one. Petty cash fund, $100. I have cash of 16 and receipts of 81. So if I'm supposed to have what? $100 and I have how much? 16. That means I need to put 84 back in there, don't I? So I credit the cash. 84. I'm debiting the expenses for what? The expenses for 81. I need a what? $3 debit. I'm cash over short. And I'm actually short, right? Okay. Verify. $100 minus what? minus 81 means that I should have been left with what, 19? Right? And I'm left with how much? I'm left with 16, so I have that $3, right? Okay. Okay, good. Number 6. Do you need to keep doing this, or you want to do the rest of these on your own for the sake of time? How many more of these do you want to do? Huh? One more? Okay. Which one? This one? Which one? 12? Did you say 12? Oh, you want to do another reconciliation one? Oh, okay. Yeah, we'll do the reconciliation ones. Let's do. You want to do number 12? You say? Okay. Okay. So they sit here and they give me what? They give me the cash balance per book. So I'm going to have to adjust for things that what? That the bank knows about that the company did not, right? Okay. So I go ahead and I start with the balance per books of 6,600. Does the bank know? Does the company know about the deposit in transit? Yes, they do. So I don't worry about that, right? That's already included. How about notes receivable collected by the bank? We don't know about that, right? So we're going to adjust that. We're going to add that 2,200 because the bank knows about that, and we're adjusting the company's balance right now, right? The book balance? Okay, good. How about bank charge for check printing? We don't know about that till we open up the bank statement, right? So that's $50 coming out. How about outstanding checks? Outstanding checks, we knew about that, right? So we don't have to adjust our balance for that. How about this NSF check? We don't know about it till they tell us, hey, your check bounced, right? Okay. So you go ahead and you do the math on that. Do you get 8330? Right? Okay. Questions, chapter 6? Break now or break later? Huh? Okay, let's take 10 minutes, guys, because we got too much stuff still. So take a 10-minute break. We'll come back and we'll pick up chapter 9. Okay. Liabilities. Mainly payroll. So we are now going to look at chapter 9. And we are going to be looking at current liabilities. Okay, current liabilities are those that are essentially going to come due what? In a year or less. So we're going to be talking about things like our accounts payable. We're not going to talk about unearned revenue because we already talked about it in the context of our discussion of revenue, but that would also be a non-current liability. Notes payable are a non-current liability. We've really talked about how to calculate interest expense on notes payable, etc., as well as part of our discussion of our chapter, when we were looking at the income statement in our earlier chapters, chapter 1, 2, and 3. So we're really going to be focusing on, in this particular chapter, on another current liability, which is basically our payroll liability. So what happens? We have to pay certain taxes for our employees, don't we? And so as a result, we're going to have to set up those taxes as being due to the government. Okay? And so we're going to be learning here that the amounts that we withhold from the employee's check are going to be called our withholding, but there's also payroll taxes that the employer pays that the employee does not have any stake in those at all. And the two main ones are our unemployment and also the employer's portion of Social Security as well. Okay, so let's just go ahead and let's start to take a look at some of these. And so let's start out with how to calculate our borrowing of money. And of course, if we borrow money on September 1st, we debit cash and we credit the note payable for $100,000 because we have borrowed that money, right? Note payable is a current liability. And then they want us to calculate the accrued interest at December 31st, and you can see it right down here, guys, and we did it 1,000 times before. I don't know about 1,000 times, but we did it several times before back in those earlier chapters where I had you taking the 100,000 times the interest rate times, and remember I kept saying count on your fingers, all of September, all of October, all of November, all of December gives us the 4 months, right? So you'd multiply that times 4/12. That gives me interest expense of 4,000. So I will debit interest expense and I will credit the interest payable because that's going to be due and payable what? The next day, isn't it? And under accrual accounting, we have to accrue that at year end. Question? Okay, so we did that last time. Okay. Okay, good. Then you come over and you take a look at the next day, essentially, when we pay off the note payable and the interest. We, of course, have to pay the entire amount of cash, 100,000 plus the 4,000, and we go ahead and debit the payables because we're paying those off now, right? Okay, so even though we're talking about this in chapter 9 now here, supposedly, we went through this whole thing in some of the earlier chapters, right? Okay. Okay, good. Let's talk about payroll then. Okay. Now what happens? We have to set up our payroll, and when we set up our payroll, we're going to have to consider these different taxes that get taken out to get sent to the federal government, the state government, whatever, Social Security. Sometimes a person wants us to take out charitable deductions that they're going to have forwarded to United Way or something like that. And then we have what? We have deductions made for union dues, insurance, all of those things. Okay. Right, the retirement, the 401k, pensions. Okay. All right, so we come over. And very important, guys, that you memorize this list, okay? You got to know this. This is one of those memorization things, which is when we talk about withholding, we are talking about the employee's share of the taxes. So we're talking about what? The federal tax that the employee has withheld, the state income tax that the employee has withheld, and then their share of FICA taxes. And FICA taxes include Social Security and Medicare. The employee has to pay into those, and so those are called withholding, because the main thing that the questions are going to get into is they're going to say, what's the withholding? And in that problem, they're going to give you taxes that are what? That are paid exclusively by the employer. Those are not withholding. Those are what? Those are employment taxes. Okay, so definitional thing is what's going to drive your ability to work these questions. Knowing withholding are the amounts that are paid by the employee, that are paid by the employer on the employee's behalf, which is what? Federal income tax, state income tax, the FICA, which is what? The Social Security and the Medicare, right? Okay. That's right. That's the withholding. Okay. All right. Okay. Now you come over, and in this example, I don't know. Oh, then they tell me just to record the payment. The employee gets the net amount, right? And that's why that lady was upset, because she only got 67,000 when she thought she should have got 100,000 for the month. She's still doing pretty good, right? Okay. All right. So let's assume that's their whole payroll. Okay. All right, good. So let's go ahead then and let's take a look at the employment taxes, the payroll tax expense, and these are paid by the employer. Now, the employer pays their share of the FICA, the Social Security, so they have to pay a chunk too. So the employee pays some and the employer has to match it, don't they? So the employer's match is not a withholding, that's a payroll tax, right? Okay. Then what? Then the employer has to pay federal unemployment tax. We're going to see that that's abbreviated FUTA. And the employer has to pay state unemployment tax. That's what? SUTA. We'll see that abbreviated, SUTA. The employee doesn't pay that, right? So when they ask you what's the withholding, you do what? You ignore this, don't you? Okay? If they ask you what's the employment taxes, you only pick these up and you do what? You ignore the employee's withholding, right? Okay? That's the trick in these questions. That's the only thing that you have to worry about here with these.
So, FICA taxes payable. Can you go to the next one, the one after? The employer's share of FICA. So it'll be broken down that way, right? Employer's share.
Well, not really, because you need to know they may just say the Social Security is this and the Medicare is this, and they'll give you the percentage. And if they're asking you for the withholding, then the employer, you're going to pick that up, for the employee. Plus, you'd have to pick up what? Any other withholding that the employee has if they're asking for the withholding. If they're asking you for the employer, you'll have to know to pick up those the Social Security and the Medicare, but not the federal and state tax. But you will have to pick up the SUTA and the FUTA. Okay, so you pick up these for the employer plus the FICA. For the employee, you pick up everything else but not these. Okay? Okay, when they're asking for the withholding. Okay? Okay, so let's just go ahead then and let's take a look here. Oh, this is unearned revenue. We took the unearned revenue question out of this test because somebody said, we already tested unearned revenue, so they took it out. I wish they would have left it in because we're very good at that now, aren't we? Okay, but they took it out. Okay, so don't worry about unearned revenue. Okay, let's go ahead and let's learn about working capital. Okay, working capital by definition is current assets minus current liabilities. Current assets minus current liabilities definition is working capital. Do you want to have a positive working capital or a negative working capital? Positive, because what? If it's negative, that means your current liabilities are more than your current assets. We have a problem, right? Okay. Okay.
Current ratio.
Huh?
And you have a bad current ratio.
You will have a very bad current ratio. If your liabilities were more than your assets, your current ratio would be less than 1, wouldn't it?
Yes.
When you look at the current ratio, it's current assets divided by current liabilities. We don't want that number to be less than 1. We want it to be what? More than 1, don't we? So 1.2 would be good, 1.3, 1.5, 1.8. How about 80? Is 80 a good current ratio? At some point, that current ratio gets so large that you say, well, shouldn't you be using that cash productively somehow in the business by investing in some assets or something like that? Why are you holding that cash position, right? Now, if the election trends the way it is, I have a feeling companies are going to be really holding a lot of cash. Okay, but anyway. But stop, John. Okay? I'm sorry to keep mentioning that. Okay? Question? Okay, good. All right, so let's go ahead then, since that's chapter 9, and let's look at the practice. That's it. That's why I saved them for last, since they were so easy, right? Let's see if they stay easy when we're looking at the questions.
Okay, strike that.
Cut. Okay. Okay, good. So let's look at this one, chapter 9. Okay? Okay, good. Now, for these questions, and in accounting, in business 101A, I typically don't recommend that you read the call to question. I always do in 1B. Okay, 101B, I always tell students, hey, read the call to question for managerial accounting. I don't really believe in it for financial. However, I make an exception when it comes to these payroll questions because you want to know what you're looking for when you go through this question. So they're asking me the amount what? The amount withheld, aren't they? And so since they're asking me for the amount withheld, I'm just going to pick up those amounts that are paid by the employee, right?
Yes.
Okay, so she earned a total of 8,260. I'm just gonna write that off to the side here. 8,260. Okay, and then the FICA tax is 6.2%, and it's 1.45% for Medicare, right? Is the employee going to pay a portion of that? Is the employee going to pay their share of that? Huh? The employee pays both of those, don't they? So we pick both of those up. The .62 gives me 512, and the .0145 gives me this 119.77, right? So I had to pick both of those up. I know I'm pointing to the solution, right? But we knew we had to pick both of those up. How about the FUTA? No, the employee does not pick that up. How about the SUTA? Employee does not pick that up. And then how about the federal income tax withheld? I mean, that's a reading comprehension thing. If it says federal income tax withheld, you know that's withheld, right? Okay, so you pick up what? You pick up this 512. You pick up this 119 plus the 1325.17. That's a total of this 195706. What? What was the cry out for? Okay. All right, want to try another one? Okay. Again, you go to the call to question on these. What is the unemployment taxes the employer must pay? And look, guys, this is just, do you know what FUTA and SUTA mean? Federal unemployment tax and what? State unemployment tax, right? Okay. Okay, so the employer pays that, and they say that they pay it on what? The first 7,000 of the employee's pay, so we use the 7,000 times the 6% for the FUTA and the what? 5.4% for the SUTA. That gives me total unemployment taxes of 420, right? Okay. Okay, good. Come down, look at this one. Unemployment taxes, the employee must pay. How much unemployment tax do the employee pay? The employee does not pay the unemployment taxes, only the employer does, right? Okay, so it all comes down to like them two slides, the one where I listed the things that we're withholding and the one where I said what? The employee pays these, not the employer, right? That's it. I mean, if you get that down, then all these questions are easy, right? Okay, how about this one? What is the amount that the employer's payroll tax expense? Okay, so what happens? They are making this 8,288. Okay, and FICA tax is 6.2%, and Medicare is 1.45. Does the employee pay that? Does, huh? The employee pays that, right? Oh, so what is the amount of the employer's payroll tax expense? So does the employer pay that? Employer pays those as well, guys. There's a matching that goes on there. The employee and the employer pays that one, right? Your employer, come on, guys. You know that your employer matches what goes into Social Security for you, don't you?
I didn't know that until tonight.
Oh, well, they do.
I know they took it out. I know it was a withholding, but I didn't know they matched it.
They take it out and they have to match it. That's the way it works. The employee, huh? Yeah, it's on both. Okay, FICA's on both. Okay, good.
The employer has SUDA and FUTA.
That's right. So that's exactly what we do here. We do what? To pick up the payroll taxes, we pick up what? We pick up the Social Security part of FICA and what? And the Medicare part of FICA, right? Employer pays both of those. You pay those. The employer pays those, right? Do you understand the term matching? You pay it, they pay it, right? Okay. Okay, good. So there's those two amounts.
On the
Okay.
full amount, too.
Huh?
And that's on the full amount.
Yes, it's on the full amount. There's the 120. There's the, I pointed the wrong one. There's the 513, right? Well, it's paid on the gross, but what he's saying is on these other two, for the Suda and the Fuda, it was limited. It was capped on 7,000. So for those two, you had to pay it what? On the full amount of the pay. But the Suda and the Fuda, they told us in the question, it is what? It's on the first 7,000, isn't it? So we capped it. Okay. So what's that come to? This 1504? Okay, so again, for the employer, it's what? SUDA, FUDA, and then their matching of what? The FICA, the Medicare and the Social Security, right? For the employee, it's what? It's the Social Security, the Medicare, what we're calling FICA here, and it's also what? It's also the federal tax, state taxes withhold, anything else that they tell you is withheld essentially, right? Okay. Okay, good. Let's take a look at this one. Um, this one is a 60-day note of 4,500 from Indigo Company to extend the due date on an overdue account. What entry needs to be recorded by Indigo Company, which is what? That's the person that issued the note. They're the ones with the liability, aren't they? Look right here. A Hong company agrees to accept a 60-day note from what? Indigo Company. How will Indigo record this transaction? Indigo's the person borrowing the money, aren't they? Right? Okay. And so if Indigo is borrowing the money, they are clearly going to credit note payable for 4,500 because they're borrowing money, right? Liability. To increase it, you credit it. Right? And since they are getting rid of this account payable, we would debit the account payable. What's the problem here, guys? This is like the easiest thing we've looked at all night. I have a note payable. I'm signing a note payable. That means I have to pay that, right? I have to pay a bill. That's a liability. You can't abandon. Assets increase, you debit them. You decrease, you credit them. Liabilities increase, you credit them. You decrease, you debit them. You're not going to make it to the finish line until you put that in autopilot, right? I mean, that's got to be like peanut butter and jelly for you by now. Okay? So what's happening? Since they what? Since they signed a note pay a bill, they are signing a formal agreement saying they will pay that, right? So we credit the note payable, and they already had a what? Account payable that they're going to take off the books because they traded this account payable for a note. Apparently they got late and they said, well, look, we used to trust you, and we just said, hey, pay us 210 net 30, whatever it is. But now, because you are late, we're going to want you to sign an agreement that you will pay us. When you sign an agreement that you're going to pay somebody money, that's called a note payable because you've signed that. You got to set up the note payable, and you're basically replacing an account payable for a note payable. So you would debit the account payable, right? Okay? Okay, good. You come over. You take a look at this one, and what is the journal entry needed to record the note payable, the payment of the note, on the maturity date? Okay, so what happens? It was a 60-day note that they signed on this April 3rd, 12th, so it's a 60-day note, so they have to pay it in 60 days. Can you calculate the interest on this? Can you calculate the interest on this?
Why did they go 60 and 360?
Huh?
Why is it 60 and 360? Wouldn't it be 60 and 356?
356. What planet are you on now? 365, you mean?
360.
In accounting, we assume that every month has 30 days.
Is that what it, okay.
Yeah, we just assume that every month has 30 days. So if every month has 30 days, 30 times 12 is 360. So that's why they use the 360. Yeah. Okay. So what happens? We're going to take the interest 60 out of what? 360 days. And we're going to multiply that times the, what's the interest rate on this thing? 10%. And how much did we borrow? 4,500. Is that the interest expense? What does that give us? Huh? $75? Chapter 2, guys. Go back and watch the Chapter 2 lecture. We did the same exact thing. We just set these up. Now, if you don't like 63/60ths, you can do 2/12ths. Right? You can do 2/12ths and come up with the same thing?
You're just saying you're doing it for 2 months.
2 months, right? 60 days. We assume every month has 60 days. So you could have done 2/12ths. And then that would have been exactly like, I mean, what I say, every month has 60 days? Every month has what? 30 days. Right? I mean, I'm going kind of fast through this because we did this in Chapter 2. I mean, I think we even had questions like this in the first midterm, didn't we? Okay. And so what happens? Since now I got to pay him this 75 bucks, I'm going to do what? I'm still got to debit the note payable for the principal, right? But now I'm going to debit interest expense for $75 because some of that is interest expense. And of course, I'm going to pay them back their principal plus the interest, right? When I pay them? Okay. Okay, good. Come over and let's just take a look at, oh, how sad. That's it? Okay, good. So that gets us through practice midterm for chapter 9. So let's go ahead and close that. Yeah, I guess I can save that. I didn't tear that up too bad. Oh, well, forget it. If you're going to make me go through all that, then don't save it then. How you like them apples? Now you don't get saved because you acted like that. Okay, and then what? Then we're going to go ahead. I'm talking to the file that wanted to be saved. And let's go and let's look at this practice midterm 2. Did you guys bring this?
You popped that up. I looked yesterday. I just saw the one on
That's it. This is the one, huh? This is it. What do you mean you just saw the one?
it. Said midterm 1.
Did I forget to put it up there? Let's see.
There's the midterm 2 practice, but it's only 3 pages.
So what are we looking for? BA 101A Section 8. Modules. Practice midterm 1. The lecture for practice midterm 1, but no practice midterm 2, huh? And put it somewhere else, maybe? No?
It's in
Chapter
chapter 5.
5?
Yeah, practice
Oh, no, but that's just chapter 5 stuff. Okay. So, That means we're not doing this then, right? Because nobody's had a chance to look at it, or we'll do it anyway.
Let's practice it while we're here.
Okay. Okay. So and then I'll put it up there. Okay. So I want to start with this question here, number 9. Okay. And sorry about that. I thought I had put it up there, but it's okay. We can go through it together while we're here together. So, Buster's Company began business January 1st, 2015. During the year, Buster's had credit sales of $200,000 and estimated that 2% of the sales will not be collectible. Before considering any year-end adjustment to the allowance, what would have Buster's taken as a provision for bad debt expense? And so what happens? We take this 200,000 of sales, right? And we simply take 2% of that, which is $4,000. Okay, so we would do what? Debit bad debt expense 4,000, credit the allowance. Okay, and I'm just going to go ahead down here and tee up the allowance right here, I think. Okay, tee up the allowance. And why not? Let's tee up the bad debt expense right next to it. And so that's a credit of what? 4,000 to the allowance. So what's the balance in the allowance now? 4,000. Good. And then we're going to debit bad debt expense for 4,000. And so far we have 4,000 in there, right? Okay. With me so far? Okay. Okay, then we say that Billy Bob said that they could not pay $500 on this account receivable. And so if we can't pay, we do what? We debit the allowance for $500 and we credit the accounts receivable for the amount that can't be collected, right? And so when we debit the allowance now has how much in there? 3,500 sitting there, right? Okay. Okay, good. So we would debit the allowance for the 500. There's that debit right there to the allowance. And then we say, number 11, assume that transactions from 1 and 2 were the only transactions that could have potentially affected the allowance account. Based on an aging of the account receivable, December 31st, 2015, Buster's determined that they need $6,000 in the allowance. Now, right now, we're looking at the allowance, and how much is sitting there? $3,500. If I need $6,000, that means I want what? $2,500 more in there, don't I? So I'm going to have to credit the allowance $2,500. And when I do, does the balance go to $6,000? The balance goes to $6,000. So if I credited the allowance, I have to debit the bad debt expense for $2,500, don't I? And so when I debit the allowance for $2,500, it comes up to $6,500. And so what's happening? The bad debt expense for the period is how much? You're seeing the same thing over here that I wrote up there. There's that $6,500, right? Right? So I put an amount in at the beginning of the year, and then I do a year-end analysis by performing an aging of the accounts receivable, whatever it is. That determines what? How much I need to adjust the allowance. And in this example, I put more in, didn't I? I could have taken some out. And if I take some out, I would have credited the bad debt expense and debited the allowance, right? If I determined I needed less. The question said, you determine you only need $2,000. I'm going to what? I'm going to credit the bad debt expense for $1,500 to take that out, right? And I'm going to do what? I'm going to debit the allowance. Okay? Okay, good. Let's take a look at this question. And we say, using the following information from this company. Oh, no, never mind. Don't look at that. Don't look at that. You'll turn to stone if you look at that. I put that question in there, and then after I looked at it, I'm like, I have no idea what they're talking about, and I don't care. Some measure that we're not going to worry about. Do look at this question, okay? You're going to get a few questions like this on your test, okay? And they're sitting here, and they want me to determine the cost of goods sold using what method? Using first in, first out, right? Now, what I have to do, since I'm using the perpetual system, I have to grab any goods that are available when I make my sale and use those prices, right? Okay, so what happens? I start out with 150 units, I buy 220, and then I sell what? I sell 140, don't I? So what cost should I use for those 140? I should use the 10 times the 140 for those, right? You see the math right there? Okay, so now that means there's how many of those left? 10 of those left, right? Okay, good. Then they buy some more, another 100 units, and then they go ahead and they do what? They sell 150 of those, right? So I still have 10 of these left, don't I? So I take those 10 times the $10 is $100 for those, and then I can take the remaining 140 from these guys, right? So I take that remaining 140 from those $12 ones, and I get the cost of goods sold there, right? Okay. Okay, good. I'm pretty sure you have questions just like this one on your test. If not the same numbers, very similar. Okay, so make sure you're comfortable with that one. Okay, good. Then what? Then they say determine the ending inventory. Okay, now when I did the ending inventory, I did it a little bit differently than the way the book did. Okay, so I don't want to give you the book solution because I don't like, I just don't want to point down here because I don't care. I don't feel that their way is intuitive. Okay, so what happens? What I did was I'm just going to add up how many units I have available. I have 150 available from beginning inventory, right? Just bringing these numbers over. I have 220 that get purchased. I have what? I then use up 140, don't I? So I'm going to subtract that. And then I buy another 100, and then I use up what? 150, don't I? Okay. And when I do the math on this, I have a total available. Well, I shouldn't have done it quite like this. Okay. Don't do it like that. Beginning is what? 150. And then I start doing the purchases, right? Purchases 220. And then I have another purchase of how much? 100. I think it's a little better organized like this. So I have available how much? I have available 470, you say? Okay, good. Then I'm going to subtract off the sales, just a little more organized. And so my sales, and I had a sale of what, 140, and then another sale of 150. Okay, so now I have an ending inventory, then what? I know that I have 180 items in ending inventory, don't I? Okay, and since they're asking me ending inventory, and it was what method? First in, first out. Okay, then I know that what? I'm going to sit here, and it's going to be 100 of those are going to be these $13 ones, aren't they? So 100 times 13 for those is going to be what, 1,300? And then I look up and what? I need 80 more. Okay, and so for those 80, I'm going to go to what? I'm going to go to the $12 ones, right? For the 80. Okay, and so I pick up the 80 times the $12. 80 times $12 is what? 96? Huh?
960.
This is ending inventory. I'm doing ending inventory now. When I did cost of goods sold, I did start from the top. This is ending inventory. FIFO, you could think of that as LILO. You could think of that of what? Last in, still here. You can think of that as LISH. The last ones in are the ones that are still here, right? Because I already sold those ones from the earlier purchases, right? So now I'm just left with these later purchases, and I only had 100 here. I need to get, 180 items. So 80 of the remaining 80 must come from here, right? Right? Okay. So what? 13 times 960 is what?
2260.
2260? Is that the answer? I had the beginning inventory. I purchased some more. I had a total available. I sold the number of units. Okay, this is what I'm left with. And in, first out, the older purchases are gone, aren't they? And I'm left with those newer purchases. And so that's how I made up those remaining 180 units. Okay? Okay, good. Don't worry about this question. We already had this. Sales less cost of goods sold is what? Gross profit. You should know that, but we're not going to ask that on this exam. Don't need to know that. Not going to ask that on this exam. Okay. How about LIFO? Do we need to know that? Okay. So let's go ahead and let's take a look at this one. And they're asking me what is the cost of the ending inventory. And I have how many units? 26 units in ending inventory. So we're assuming that it's what? Last in, first out. So these earlier purchases are all gone, we assume, don't we? So we're now assuming that we're left with these ones in the bottom of the pile. So there's 10. How many do I need total?
26.
I need 26 total. So I've got 10 at 120. That gives me what? 1200? Okay. And then I'm going to take what? 16 more from here. So 16 times 125 is what? Huh? 2,000? Okay, so the answer is here, what, 3,200? Okay. Oh, okay. I did all that writing, and there it was right there.
Quarry one that you used the example.
Last in, first out. This is the rock quarry upside down. Because they're showing them on the top. I was showing them on the bottom. But yeah, that's the rock quarry. Last in, first out. They sell these first, right? And they're left with these on the bottom. In the back, whatever, however you want to look at that. Okay. Okay, good. Don't worry about this question. We have already dealt with your understanding of 210 net 30. Don't worry about this question. Don't worry about this question. Don't worry about this. Don't worry about this. Don't worry about this. Even though it's a allowance question, I don't like it. I don't like these questions anymore.
Are you
So
gonna
don't,
put it up like this with all the no?
with the X's?
Yeah.
No. Okay. Okay, good. Let's go ahead and let's deal with depreciation. Okay? Which we did last time, chapter 8. Okay? Okay. So, oh, am I going to put it up with the X questions? Yeah, I can do that. Save it with so you know which ones. Yeah, I'm sorry. I thought you meant the test. Am I going to put it with the X's? No. There'll be no X's on the test, but yes, I'll put it on the I'll put it up like this, sure. Okay, so what happens here? We have an asset that we purchase on October 1st at a cost of 100,000. Salvage value is 20,000. We're going to use double declining balance. Do we worry about the salvage value for double declining balance? Well, we keep it in mind because we don't depreciate below the salvage value, but what? We don't use it in the calculations, right? Okay, so you've got this 100,000 that they purchased the asset for, and they tell us that it has a 5-year life. So we take 1 divided by 5 equals what? 20%, and we multiply that by 2 if it's double decline balance. So we're going to take 40%, aren't we? Right? So we multiply the 100,000 by 40%. That gives me 40,000, but because they bought the asset October 1st, it's all of October, all of November, all of December. It's 3 months, right? So I take 3/12. So that first year, I'm going to take 10,000, right? Okay. I take that 100,000 minus the 10,000 depreciation for year 1, and so now my new carrying value on that thing is what? 90,000, isn't it? Right? I bring that 90,000 over, and I now multiply that by 40%, and there's no fraction of the year now because I've owned this for the whole year, haven't I? And so that gives me the year 2 depreciation expense is 36,000, and so now the what? The book value on that asset has gone down to 54, right? 90,000 minus the 36 gives me the 54, which is what they were asking in this question. What would be the book value at the end of year 2? Hello? Double declining balance? Okay. Okay, good. Come over and let's take a look at this one. PV purchased a depreciable asset for $22,000 on April 1st. The asset will be depreciated using straight line over its 4-year useful life. Assume the asset salvage value is $2,000. What should I do for the depreciation? And now they want me to give them the accumulated depreciation, what? At the end of year 3. So I got to do a little record keeping here, don't I? Okay. So what happens? 22,000, and now I do subtract out the salvage value, right? Divide that by what? The 4-year life, and since they bought that asset on April 1st, it was only being used for 9 months. All of April, all of May, all of June. Count on your fingers, right? So for the first year, I only take 9/12. That's 3,700. In year 2, I do what? Take the full depreciation, and I take the full depreciation in year 3, don't I? And so the accumulated depreciation would be that total at the end of year 3. Right? Okay. Okay, good. How about this one? McCarthy has inventory of 8 units at a cost of $200 each on October 1st. On October 2nd, it purchased 20 units at $205, and then 11 units are sold on October 4th. Using FIFO perpetual inventory method, what was the value of the inventory after the October 4th sale? So on October 4th, when we sell this inventory, we do what? We got to sell 11, so we get rid of all 8 of those, don't we? Those are all gone. And then what? We still need, if we sold what? 11, we still need 3 more units, don't we? So we grab them from these. So if you subtract 3 from that, you're now down to what? 17 times the what? Times the 205. There's a calculation right there. Gives me the 3,485. Okay. Okay, good. Then what? They say, well, what if you're using FIFO? Same facts now, right? But now we're going to use FIFO for the cost of goods sold. Everything else is the same, isn't it? Okay. So if I'm going to use FIFO, now what? First in, first out. So, oh, what are we asking here? This is now the cost of goods sold. I'm sorry. It was already FIFO, but now it's cost of goods sold. Before it was what? Before it was ending inventory. Okay. So if it's cost of goods sold, what's going to happen? I sold those 8 units, didn't I? And I sold them at what? $200 each. Okay. What's that give me? 1600. Okay. And then what? Then I sold another what? 3 units from here, and those go out at 205. 615, you say? Okay. And so that gives me what? This 2215. Okay. Okay, good. Here we go. I knew that somewhere we got into the same fact pattern for what? LIFO. And we want what? Cost of goods sold for LIFO. So we're going to sell, how many did we sell total? 11. So we're going to sell straight from here, aren't we? Since those were the last in, first out. So 11, all at 205, gives me that answer. Right? Okay. So, I mean, these questions are sort of like weightlifting, aren't they? I mean, if you don't practice with them, it's real hard to figure them out. But once you get good at them, they get pretty easy, right? Okay, so you got to keep working with these. What happened now? They want the ending inventory. Okay, so now they want the ending inventory. Last in, first out means that I know I've got what? I had 28 units total, and I've sold how many? 11, so I have how many left? 17, of which what? 8 of them are all at $200, right? And then what? And then the remaining 9 got to be those 205 ones, don't they? Okay. Okay, so let me save this. I don't know why it's got a. I would have sworn I downloaded this from the. But it's not there, so I'm not sure why I'm thinking that. So you guys ready to go home then, or what? Huh? Or you want to go and look at some other files? Okay, let's see. Quizzes. I don't know why this thing is giving me such a hard time here to save this. Okay, so I think I can close this now. I can close that. And I am going to stop this.